advantage funds, or as they're also often called, dynamic asset allocation funds. And the wonderful thing about this product is that it does the job of asset allocation for you. And asset allocation, as we know, is an extremely important feature of personal finance planning. So we decided to bring on board the fund manager of one such fund, the Invesco India Dynamic Equity Fund, which is managed by Taher Badshah. He's also, in fact, the CIO for Equities with Invesco Mutual Fund. Taher, thank you so much for taking out time and joining us on the Money Show to talk about this fund and this mutual fund category as well. But before we talk about this category and, investing in it amidst these times of, extreme bullishness in the Nifty and in the equity markets, start by telling us a bit about the Invesco India Dynamic Equity Fund. Where does it invest? How does it usually split itself between equities and debt?
Yeah, so the way we've generally run this strategy is that, of course, it is a strategy amongst all our strategies, which is a lot more cognizant of risks, and basically it is a lot more configured towards protection of downside, and to that extent, therefore, it can be probably construed as a bit of a defensive strategy. And we therefore try to exercise a defensive approach in all possible ways. Basically, the way we do it is that the asset allocation is driven by our internal proprietary asset allocation framework, which essentially is a combination of certain valuation parameters. And we look at a combination of trailing price to earnings along with the absolute level of interest rates. And we also look at differential of earnings yield versus bond yields as a tool in order to configure our investment framework, and which in turn decides the asset allocation at any point in time. So that's how we determine the element of equity exposure as well as fixed income or cash exposure that we have in this fund at any point in time. For the equity portion of the fund, what we also do essentially is this fund largely tries to buy into companies which develop earnings, or where we can probably see earnings and price momentum developing. So basically the choice of companies out of our investable universe or the preference is for companies out of our investable universe, which in the next few quarters can show tendencies of better earnings growth or better earnings momentum, probably can beat street estimates going forward. And also we see certain elements of price momentum as well building into it. Then those are the stocks that qualify from a fundamental standpoint into the equity component of the portfolio. So we are trying to provide earnings momentum, but at the same time, the asset allocation pattern is what determines the risk management or the downside protection to the fund.
All right. I know you briefly alluded to it in your previous answer, but the factors that you look at when you are changing the allocation between equity and debt, what are the factors that you look at when you have to decide that, okay, maybe now is the time to perhaps trim a little bit from equities and increase a little bit in debt? And how much do you really swing in percentage wise?
Well, I think we've configured bands of asset allocation which move in sync up and down with the movement of the markets on valuations. Like as I said, the primary valuation metric that we use is trailing multiples on the Nifty, and which have, at least in the more recent past, probably have seen very violent movements as a result of not just the movement of the denominator, which is the prices, but also the movement of the not only the movement of the numerator, which is the prices, but also the movement of the denominator, which is the earnings profile. So we've seen very significant changes to the earnings profile of corporate India over the last 18 months. And that at one level does led to a very sharp movement in the asset allocation pattern over the last 12 to 18 months time. But this fund is, of course, has a history of more than 10 years. And over the last 5 to 7 years, we can very confidently say that the asset allocation has probably moved in tranches of say 5% in most times. So we would have probably moved from, let's say, 50 to 55 or 75 to 65 and 60 or some such. So it's not very violent in terms of the asset allocation in regular times. But over the last 1 year, probably it has been a little more enhanced. At all times we have basically tried to dispense with personal judgment or individual biases with regard to asset allocation pattern in this fund, and that is why we've submitted ourselves to the outcomes from what is thrown up by our proprietary model. We have had to make certain concessions over the last 12 to 18 months, particularly because, like as I said, the movement of earnings on a trailing basis as well as on a forward basis has been significantly sharp in that period of time. But otherwise, we have generally not tried to interfere or bring in our own personal reflections onto the asset allocation. We have been guided by the framework, depending upon what the combination of price to earnings as well as the differential between bond yields and earnings yield throws up. We have pre-configured bands, and those pre-configured bands is where we try to balance the portfolio when that need arises. So I think we don't have very large movements, except for, like as I said, in the more recent past. We probably would be relatively more gradual in terms of the movement in asset allocation one way or the other.
So right now, Taher, in fact, as we speak, Nifty is at record high levels, and market participants have already split themselves into two, and a majority of them believe that, okay, we are a little expensive. You mentioned that, the multiples are a big factor that you consider when deciding on what your equity allocation should be for this particular fund. So right now, what's your strategy then for the fund?
See, right now, as things stand today, we have a net equity allocation which is in the vicinity of around 58%. So we are nearly, you can interpret to be about somewhere in the 50-50 range. I mean, we are equally balanced between our equity exposure and cash to fixed income exposure. So we probably think that as of now the fund is relatively well balanced from the point of view of the risk versus the reward. Of course, we are cognizant of the fact that the markets have gone up significantly sharply in the recent past. Valuations may have not moved dramatically upwards, but nonetheless, they are higher compared to where they were about a year ago, and that has necessitated some moderation in our equity allocation. So that adjustment has been made. Today at 58% net allocation and about 77% on the gross allocation, we feel reasonably fine. We feel reasonably comfortable with regard to the potential risk which could emanate at these levels of the market, and the potential reward which probably can also come about if earnings upgrades were to come about and we see economy stabilizing faster. The one thing that I wanted to probably also mention is that in achieving our net allocation from in our fund, we have earlier we did used to resort to primarily hedging through Nifty Nifty futures as a mechanism. I think over some of these years we have realized that Nifty is not necessarily the best hedging tool, because we've had very meaningful periods of the market when perhaps the broader market has significantly corrected, but the Nifty has not, and we have times even when the broader market is significantly positive, like for example today, but the Nifty is just moves up relatively more gradually. So in the last 1 year, for example, as you know, that the broader market, the mid caps and small cap indices have done significantly better than the large cap index. So what I'm trying to say essentially is that we've now started to resort to a combination of individual, company specific hedges along with Nifty as a hedge too. So that leads to a better balance in terms of being able to capture the downside as and when the market corrects, because many a times we found, as I said, that when the markets correct, the Nifty generally, because of its composition, tends to hold up relatively better. So in order to overcome that challenge, we are now resorting to a relatively better combination of individual stock level hedging along with index level hedging as well. So I think these are some of the nuances that go into the management of the risk or the management of the downside in the fund. Today, as I mentioned, we think we are somewhere in between with regard to our risk reward exposure in this fund.
All right. I want to sort of break down your entire strategy with numbers. When we saw this is such an old fund, right? So when we saw in March 2020, when there was that rapid fall, how did the Invesco India Dynamic Equity Fund sort of cap that fall versus what we saw in the markets? And, every downfall, how have we seen the Dynamic Asset Fund really cap any sort of massive volatility?
So, we entered 2020 just before the pandemic with, equity allocation as high as nearly 80%, because we entered into this, into that calendar year with an expectation that the overall economic picture in India would improve, and we were reasonably positive about the overall outcomes in the market. So we had increased our asset allocation towards equities to a very high level at that point in time. Which subsequently in the month of March, around and probably a little before the correction, we had, and during the period of the correction, we took it as all the way down to even 40%, or a little shade below 40% as well. So that was in the height of the pandemic, in the depths of the market, in the first quarter of 2020, or the first maybe about 6 odd months of 2020. Since then, we have gradually, increased that asset allocation. It has gone through a little bit of volatile times. Like as I said, that the asset allocation pattern has made more sharper jumps during the last 12 odd months. But as the market, as this fund is also being configured to play the recovery in earnings or the momentum of earnings that we see in various individual bottom-up stock choices, we've also commensurately increased our exposure, long-only exposure to the fund during the space of the last 6 months. So from the depths of 40%, we have gradually inched it up to close to about 60% as we stand today. So we've had that kind of a movement, if I were to map it out over the last maybe 12 to 15 odd months. But I think we have got longer-term trends which indicate that we have seen reasonably positive outcomes of protecting downside during times of extreme volatilities of the market through this fund.
So, just for the benefit of our viewers as well, to wrap up the sum and summary of this conversation, right now with markets, at 16,000, in the event that, we see a correction come by or even a fall, God forbid if there's a third wave that, is perhaps in the near future, how will your fund protect and the debt portion as well cushion some of the volatility that can come? And do you believe then that in this circumstances retail investors should have the dynamic assets fund in their portfolio?
I think this is a good time for this kind of a strategy to be used for investors who are a little jittery about the sharp movement in the markets in the more recent times and the a little bit of frothiness which we've seen in certain pockets of the market. These kind of strategies can be very handy, which give you the ability to kind of maintain a certain level of minimum exposure to the markets, to the equity markets, and alongside also provides you the necessary cushion that in the case of very sharp reversals of the market, these kind of strategies should be able to protect downside too. So by itself and by its very nature, this strategy does that bit of risk and downside protection, alongside which we as fund managers and in running the strategy, the way we do our take our exposures to the equity component of the portfolio as well. As I said, we are driven by earnings growth and earnings momentum that we see in these enterprises. And we would like to think that therefore, even if there were conditions around the market which lead to probably sharp downward drifts, some of the companies which probably show better promise on earnings would probably be able to hold up better. And therefore, going by this preference for companies with strong earnings momentum should add to that, add to further downside protection, and allow some of these stocks to outperform the market during this period. So we are trying to add layer after layer of protection as much as possible, even to the equity component of the portfolio. This fund also has kind of tried to keep a very minimal exposure to mid and small caps as a category. So even of the gross exposure that we run in this fund today at about 75 odd percent, roughly about 60% of this is in large cap stocks, and the balance 15 odd percent is in a combination of mid and small cap names. So like I said, layer after layer, in every possible way, we are trying to maximize the benefit that we can get out of the average equity component that we hold in this fund, along with, of course, the asset allocation part, helping to control risk, downside volatility, and any kind of downward drift in the markets.